Welcome back to Investing Talk Podcast. Today we're tackling a question that's likely on many of your minds. Is Sharps technology a good time to buy now? We're going to break down all the available information about the company so you can make an informed decision. Before we jump in, if you find value in our discussions, please hit that subscribe button, like this video, leave a comment, and maybe consider buying us a coffee. And of course, if there's a specific company you'd like us to look into, please do leave a comment below. Sharps Technology, trading as STSS, has been buzzing recently. It's a medical technology company that's suddenly making waves with a significant and somewhat unexpected financial move. There's been a lot of discussion around its strategic shift, specifically, into the crypto space. This isn't your typical medical device story, is it?
It's certainly not, no. My mission today is really to try and cut through the noise surrounding STSS, look at the facts from the latest reports, and help you understand what's truly going on here. We'll look at everything from their financial health, community sentiment, and what could be coming next for this. Well, intriguing company.
Okay, so let's dive right into the headline-grabbing news. The thing that put STSS squarely on everyone's radar, a substantial $400 million private placement. And what's really caught people's attention is that this capital is specifically earmarked for establishing a Solana treasury. That's quite a bold move for a medical tech firm.
It is. What's truly fascinating here, and it is a significant pivot, is the immediate impact this had on community discussions. You see traders actively debating whether this move signifies a savvy, forward-thinking leap into the blockchain space, showing foresight, adaptability.
In a sector that's not exactly known for moving fast.
Precisely. Or, on the flip side, if it's a potentially risky overreach, maybe even a distraction for a company still developing its core medical technology. The sentiment is just sharply divided. It really highlights the high stakes involved.
And this isn't just theoretical chatter online, is it? We're seeing real-time reactions in the market, or at least in how people are talking about the stock. Community members are closely watching the price action. Some are anticipating a continued climb, seeing this $400 million, the Solana play, as a profoundly bullish signal for future growth. Others, though, are cautioning against potential downside risks, reflecting that deep uncertainty about, the viability and the execution of such a strategy.
Exactly. It's a classic risk-reward scenario playing out right now. The hope, I suppose, is that this new venture could unlock entirely new revenue streams or maybe attract a different class of investor. But the concern is that it could delete focus, resources, and ultimately shareholder value away from their core medical business.
Right. And while the headlines grab attention, the real story often lies, buried in the numbers. So let's pull back the curtain on Sharps Technology's core financials. When we look at their most recent SEC filings, the 8K, the S1 forms, and that S1A from January 22, 2025, what immediately stands out is the absence of detailed revenue and net income figures for 2025. What's the practical implication of that? Does it suggest a red flag, or is this sort of thing typical for a company at this stage?
That's a crucial point. It tells us that they haven't reported meaningful recurring revenue, not the kind you'd expect from a, let's say, mature medical device firm. This clearly indicates they are very much in an early-stage growth phase. So for investors, this means the company isn't generating consistent income from selling products yet. Its financial health isn't built on operational cash flow. It's still very much in the investment and development phase. Now, that isn't necessarily a red flag for a startup, but it definitely implies higher risk.
Okay. In this early-stage nature, it brings us to their financial health and how they're funding everything. This recent capital raise, August 25, 2025, through private placements. It involved issuing stock and warrants at $6.50 per share, and these pre-funded warrants at basically the same price, 6.49999 cents. This substantial capital is intended to fund the Solana treasury operations and support general capital needs. Now, for our listeners, what does this move truly suggest? And what are the potential implications of financing through private placements like this?
Well, it suggests a clear and probably ongoing need for more liquidity, more investment, which, as we just discussed, is pretty characteristic of early-stage businesses. Private placements are a common way for companies like this to raise capital quickly, often from institutional investors, avoiding the tougher requirements and public scrutiny of a traditional public offering.
But there's a catch.
There usually is. It nearly always results in shareholder dilution. Every new share they issue means your existing shares represent a slightly smaller slice of the company pie. And that can hit the per-share value if it's not balanced out by significant growth or creating real value down the line. So yes, it brings in much-needed cash, but it comes at a cost to existing shareholders.
Okay, this is where it gets really interesting when you think about where they sit competitively. Sharp's technology is in the medical technology sector, focusing on these innovative, safe syringe and injection products. But they're definitely not alone in that space, are they? How hard is it for a smaller player like Sharps to even get a foot in the door with a new syringe when you've got giants like Becton Dickinson, BD, and other big medical supply firms already there?
Oh, it's an uphill battle, to put it mildly. These established players, they have decades of relationships with hospitals, with healthcare systems. They have massive manufacturing scale, huge distribution networks, and deep pockets for R&D and marketing.
Right.
So for Sharps, their competitive advantage really relies heavily on bringing out new products, having strong intellectual property, maybe landing some key partnerships. But as of mid-2025, let's be honest, their current market position and their demonstrated competitive moat, that sustainable advantage against rivals, it looks quite limited. They're still really in the proving phase. Proving they can scale up and actually disrupt a market dominated by these incumbents, it's just not enough to have a clever product. You need the whole infrastructure and market access to make it a commercial success.
Okay, so if we connect all that to the bigger picture evaluation, traditional ratio analysis for STS gets tricky fast. You mentioned no real revenue, so they don't report a trailing price to earnings, a PE ratio, because they have net losses. And similarly, price to sales, PS, and price to book, PB, ratios are hard to assess meaningfully for a company that's pre-profit, early stage. So if we can't really rely on these traditional metrics, how do investors even begin to value a company like Sharps Technology? Where do you even start?
That's the million-dollar question, isn't it? Or maybe the $400 million question here. When traditional metrics like PE are just not there because the company isn't profitable, or when PS and PB are skewed by tiny revenues or speculative asset values, investors have to shift their focus. As of, August 27, 2025, STSS is trading around that recent private placement price, about $6.50 a share. Now, mature players in this industry might trade at a price to book around 2 or 3. STSS is likely trading at a much, much higher ratio. Why? Because of speculative growth expectations.
So it's all about hope and future potential.
Essentially, yes. It's about what investors hope it will achieve. Trying to do a discounted cash flow, DCF analysis, it's just not practical right now. They lack consistent revenue, they have negative earnings. So the market valuation depends far more on the perceived promise of its technology pipeline, both the medical devices and now this blockchain venture, than on traditional financials. It really is a bet on the future, not the present performance.
Okay, let's shift gears slightly to technical analysis. The stock price is currently trading in that, say, $6.20 and $7 range, consistent with the recent private placement. But you mentioned liquidity is thin. That can make short-term price swings a real possibility. Chart data suggests support near $6 and maybe some resistance in the $7.50 area. For people who rely on technicals, how does this thin liquidity specifically impact reading the charts and maybe trading strategies?
Yeah, thin liquidity is definitely a double-edged sword for technical traders. On the one hand, it can lead to really dramatic price moves on relatively small amounts of buying or selling. That can be exciting if you're a short-term trader looking for volatility.
Get in, get out quick.
Potentially. But on the other hand, it makes many technical indicators much less reliable. Take moving averages, for example. They usually help smooth out price action, reveal underlying trends, but they're pretty unreliable for STSS. Why? Because with very thin trading and frequent price gaps between trading days, the data points just aren't continuous enough to form a meaningful average. You often end up with misleading signals instead of clear trends. The Relative Strength Index, the RSI, is apparently approaching overbought territory after the capital news. That might suggest some caution for anyone jumping in late. But again, without consistent volume behind the moves, it doesn't really provide a concrete multi-day trend signal. It just underscores the speculative nature here. Those news-driven spikes can vanish pretty quickly.
Okay, so focusing on recent developments and news flow.
Well, the most notable event, as we've discussed, is that August 25th capital raise. And it wasn't just to fund the Solana treasury and general needs. It also coincided with appointing a new chief investment officer. Now, that hire is actually quite significant. It signals a pretty serious intent behind their new crypto-focused direction.
They're putting someone in charge of managing that treasury specifically.
Exactly. What's also interesting is the lack of mainstream analyst coverage. No rating changes as of August 2025, which again just highlights its early speculative nature. Large institutional research desks, they typically don't cover companies without established revenue and a much clearer market footprint.
Right. And what about insider activity? That often gives clues about how management feels. On August 22, 2025, a director, Jason L. Monroe, was granted an option to purchase 80,000 shares at $6.41 per share. It's exercisable by May 2026. Importantly, you mentioned we haven't seen any reports of insiders selling their shares. What does this specific activity, an option grant but no sales, tell us?
Generally, it's seen as a positive sign. An option grant like that ties the director's personal financial interests directly to the company's future stock performance. If the stock price goes above his $6.41 exercise price, that option becomes valuable.
So it aligns incentives.
It aligns incentives, exactly. And the fact that no insiders have reported selling means they aren't, cashing out or taking profits at these levels. That could suggest some confidence in the longer-term potential, or at least maybe a lack of immediate concern. However, it's also worth pointing out that social media sentiment, while it's there, remains largely speculative. The volume is limited, and there's no clear consensus. It's more just individual chatter than any kind of unified market signal.
Okay, looking ahead then. What potential short-term catalysts should our listeners be keeping an eye out for? What could move the stock in the coming weeks or months?
In the short term, potential catalysts could include things like further announcements about the corporate capital structure, maybe details on how that treasury is managed. Upcoming quarterly reports will be watched, though frankly we're not expecting significant revenue yet. And any concrete progress on that announced Solana-based blockchain treasury platform. Any news detailing how they actually plan to use that treasury or what specific applications they might be building on Solana, that would certainly generate buzz.
But not much on the medical device side short term.
It seems not. It's worth noting no specific product launches or, crucially, FDA approvals for their medical device side have been flagged in recent disclosures. The focus seems elsewhere for now.
Okay. And what about the longer-term potential? What could really move the needle for Sharps technology further down the line, say, over the next few years?
Longer term, the catalysts could be more substantial if they materialize. Things like actually scaling up commercial sales of their core medical device products. That would be a huge step towards stable revenue, proving the original concept. Securing significant partnerships or distribution deals within the healthcare sector would also be transformative. That could give them access to those established networks we talked about earlier.
The ones dominated by BD and others.
Precisely. Even potentially entering into merger and acquisition discussions could be a possibility if their technology pipeline, or maybe even their blockchain strategy, proves compelling to a larger player. And then there are broader factors. Wider adoption of secure medical devices, or maybe favorable regulatory developments in either the medical or the blockchain space. Those would also be highly significant. They could open up new markets or streamline their path to commercialization.
So let's try and bring all these threads together. We've talked financials, competition, valuation, news, catalysts. What does this highly speculative picture mean for you, our listener, if you're considering an investment in Sharps technology? What are the key risks you absolutely need to understand?
It means you really need to consider not just the company-specific risks, but also the broader market and sector risks involved. Sharps technology faces substantial early-stage company risks. A lack of recurring, stable revenue that's fundamental. There's a clear reliance on continued capital raises, which brings that ever-present risk of shareholder dilution we mentioned. Product development uncertainty is just inherent in any tech company, especially in the medical field with its strict regulations. And as we highlighted, significant competitive threats from these entrenched players. These are not minor hurdles, they're major challenges.
And beyond the company itself, what about the external environment, the bigger picture?
Right. From a broader perspective, market and sector risks include potential regulatory shifts. Healthcare and medical device markets can change based on government policy, which is unpredictable and can be costly. There's also the possibility of rapid technological changes. What if someone else comes up with a better syringe or a better safety mechanism? That could make their innovations obsolete if they don't adapt quickly. And of course, general macroeconomic uncertainty. That affects small-cap growth stocks like STSS disproportionately. Investors tend to flee riskier assets during downturns.
And now there's the crypto risk layer too.
And now you've added this whole other layer with their venture into the highly volatile crypto market. That introduces another significant layer of market risk that could swing wildly based on factors entirely unrelated to their medical products business. Bitcoin goes down, maybe STSS stock gets hit too, regardless of syringe sales.
Okay, so based on everything we've discussed, the overall rating we've landed on for Sharps technology is a 3 out of 10. That's a fairly low rating. Can you elaborate just a bit more on the rationale behind that number?
Yeah, a 3 out of 10. The rationale is pretty clear, unfortunately. Sharp's technology is highly speculative, very high risk. Now, while there's maybe a glimmer of opportunity based on their new technology, the recent capital raise, and this admittedly bold move into Solana, it fundamentally lacks stable revenue. It lacks consistent cash flow. And it lacks demonstrated industry traction in either of its declared segments, medical devices or blockchain, yet. Its future really depends heavily on successfully commercializing those medical products and very adept capital management of its new blockchain venture. This dual-track strategy, while ambitious, just makes it a very high-risk proposition, particularly in volatile or risk-averse markets.
So what does that mean for different types of investors?
For you, the listener, the investment horizon for STSS might be suitable for short-term speculative trading, if you're into that. Trading on news-driven price spikes, but only if you're comfortable with extreme volatility and making very rapid decisions. However, based on everything we see now, it is not currently a strong candidate for long-term investment. The financial instability and the developmental uncertainty across multiple fronts are just too profound. It's essentially, as we said, a bet on potential, not on current performance. A lottery ticket, maybe?
A very expensive lottery ticket, potentially. So there you have it, a comprehensive look at Sharp's technology, a company navigating a really fascinating, though, as you said, high-risk pivot into the crypto world while still somewhere developing its core medical technology. It truly underscores the importance of weighing that future potential against the cold, hard, current financial realities.
Exactly. Understanding the highly speculative nature and the sheer multitude of early-stage risks is absolutely crucial here. It forces investors, forces you to think deeply about your own risk tolerance and your investment time horizons. Is this really a fit for your portfolio?
And this whole situation raises a really interesting broader question for you to consider as we wrap up. Given the high speculation we're seeing around early-stage companies entering new, often volatile sectors like crypto, what does this tell us about the current market's appetite for risk? And how effectively can we as investors truly value future potential versus solid, present fundamentals in today's rather complex landscape? Something to think about. Until next time.